Hey guys, my name's Ravi Sharma and I'm the founder and buyer's agent here at Search Property. Thank you so much for joining me on yet another episode of Search Property TV. If you're new here, smash that subscribe button, hit the bell icon and drop me a like because, well, the YouTube algorithm does its thing. Now, today's video, very important. We're talking about how starting early can actually compound into huge amounts of growth, and it actually requires less work and less capital if you start early. So if this is something of interest to you, then keep watching. Now, before I continue any further, I need you to go down to the link in the description below and join our private Facebook group, Passive Income and Australian Real Estate Tips. You can search it up on Facebook or smash that link in the description. But essentially, I'm building a community around passive income, real estate, and saving tips. This is about getting ahead in life and getting your financial literacy upgraded. So I want you to be part of the community. So come join me on the inside, and now we'll continue the video. For the purpose of this video, I want to show you an example of a house worth $300,000 today and what that looks like at the age of 50. Now, most home loans will get paid off in 25 to 30 years. Of course, there's rental growth that really capitalizes on that growth and allows you to pay down your loans even quicker. But for the purpose of this, we're just going to say, look, it's going to take 30 years and we're going to assume that there's a 4% compounding capital growth. Now, 4%, very conservative. If you're looking in the right locations and you've got the research to back it up, you should be achieving a lot more than this. If you haven't already, definitely go check out my video about my portfolio and all my 13 properties, and I break them down for how much I purchased them and how much they're worth today. So definitely worth a look, but for now, we'll continue this video. So if we were to start in our 20s, so let's just say we assume we start at 21, then we'd retire at 51. But in this case, we're starting in our 20s. That would allow us to purchase a property for $300,000. Now, in order for us to obtain that property, we also have to acquire debt and we need deposit. So usually at 90% lends, we would be able to get a loan of $270K, and our deposit therefore would be $30,000. So in order to get into a deal like this, you would need $30,000. Of course, there are other costs like buyer's agency fees. You've also got conveyancing fees and your pre-purchase inspections. But we're not concentrating on that. If we were to purchase a property in our 20s and simply did nothing, had the tenant there, pay down the loan, help you pay down the loan, and essentially at 50, you would have a property that has zero debt, which is pretty good, and the value of $973,000. Now, for some people right now, they're thinking, you're telling me that a property I purchased today worth $300,000 could be worth $973,000 in 30 years? You've got to be kidding. Truth is, people in Sydney or people in Melbourne, even in regional centers, 30 years ago when their properties were selling for anywhere from $30,000, yes, $30,000, all the way up to about $250,000. If I had gone up to those people and said, look, your $30,000 property right now is going to be worth $600,000 in 30 years time, or that the property you purchased for $150,000 in Sydney is actually going to be worth $1.6 million. At that point, they would have looked at me as well and said, you're an idiot. Essentially, we aren't able to really forecast and see ourselves in reality what that looks like. And this is a fundamental flaw within our society, especially our generation, where we become so concerned with the immediate, the instant gratification from something. So we actually aren't able to see what future looks like, and that's why that stops us from actually investing. So in this case, we're assuming the 4% capital growth. Now, it could be high, it could be lower. And I don't know who's buying these properties, but essentially I know for myself, I'm using at least 4% as a very conservative number. Now, growth is not linear. It does go up and down. But as an overall, if you looked at history in Australian real estate, they tend to get an average and it's usually about 7%. But for this example, we're going to go with 4%. $30,000 of your money, you purchase a property for $300K. In 30 years time, you'll have paid down the loan. Now, if it's positive cash flow, you don't even have to worry about paying it down from your own pocket. The tenants will do it for you. But essentially, you'll be left with an asset worth $973,000. I don't want to go into too much detail around rentals, But if that's something that you really want to look at, then definitely leave me a comment down below and I can go through this example with some rental numbers too. For now, we're just going to focus on value, purchase price, and also the debt level of debt. So it's not always possible for people to come in and purchase in their 20s. There's some of you that may be watching that are actually already past that age. So you might be in your 30s and going, okay, well, does that mean I missed the boat? No, definitely not. I love the saying where the best time to grow a tree or plant a seed was 20 years ago, and the next best time is now. So if you are in your 30s, do not be discouraged. I'm just going to show you exactly what that looks like. But what I'm trying to illustrate with this example is the advantage of starting early. You starting at 20, you starting at 30, you starting at 40, again, comes down to your own strategy, your own goals. But by starting early, you're having to do less because the compounding growth that occurs afterwards is mammoth. So let's say you're in your 30s and now you're purchasing the exact same property, property A, for 300K here. But now that property has grown in value. It's been growing by 4%. So now you can't purchase for $300,000. The market's moved from there. Now the purchase price is $440,000. $444,000. If we're going to borrow 90% of the home value, we are now borrowing about $400,000, and your deposit therefore is about just under $45,000, but for the purpose of this, we're just going to keep it $45,000. So the immediate difference we can see is you're not entering at a price point of 300K. You're entering at $444,000. The other thing to note is your deposit amount has gone from $30,000 to $45,000. Okay, so your level of debt to acquire this property is now no longer $270K, it's now $400K. And you can already see the difference just 10 years could make on a property like this, how to enter, although is only a difference of $15,000, the level of debt you're going to be acquiring to obtain this property is going to be a lot higher. At the age of 50, because it is the same property and it's growing at the same rate, the value will be the same. So $973,000. However, it's now been 20 years that you're going from 30 to 50. So you still have about 10 years left on your loan. So that means you have some debt left over. So after 20 years, you would have $168,000 in debt. So the clear difference we can see already is at the age of 50, you own a property worth $973,000, but you acquire no debt. You've paid it off. In this scenario, if you start in your 30s, so just 10 years later, you would acquire a property worth the same thing, but now you still have debt, and that debt is of $168,000. This is what the difference of compounding interest can look like. And although in this example, you may not look like you want to retire at 50, it's about having more choices. So let's say your 20s, you spent some really good time traveling and you thought, you know what, no, I'm more interested in putting great photos of myself and these luxury cars that I could never afford onto my Instagram page, and I want to enjoy life. Ravi, you're talking about something in the future, I'm not interested. I want to live life now. Okay, no worries. So then you get into your 30s and you might settle down, you might not, and you say, you know what, I'm still not ready. I don't want to take up loans and invest. I want to enjoy life, and now I've maybe got a few kids, or maybe I'm married. Everyone's different, but essentially you might be in 30 and you go, you know what, no, I'm not investing now. What's another 10 years going to look like, or another 5, 6 years? Maybe you're in your 40s now, and look, this isn't having a go at people that are older and haven't made those decisions. It's just to illustrate one simple point, that is to start early. If that means you can start today and you're 43, start today. If that means you're 56 and you can start today, start today. If you means you are 20 and you need to get your mindset right because you don't have the deposit, start today. But essentially, I want to cover off what 40s look like, and you're going to see a stark difference between starting at 20 and the amount of work you would need to do to pay down that loan versus if you started at 40 and started taking your finances seriously. So you've gone and purchased the same exact property, makes it easier. And now the purchase price is $656,000. Your level of debt at 90% would be $591,000, which means your deposit amount is going to be $66,000. Okay, so some very high level differences. We've gone To purchase the same property 20 years ago, I needed $30,000. But now, for me to purchase that now at 40, I have to require almost more than twice the amount in order to do it. Not only that, but here, we only had to acquire $270,000 worth of debt. Now we have to acquire $591,000 worth of debt in order to go and obtain and purchase the same property. So of course, if we're looking at the same property, the value is going to be the same at age 50. But can you guess what your debt's gonna look like? You've got 0 if you start at 20. You've got 168 remaining if you start at 30. If you start at 40, the amount that's gonna be remaining in terms of your level of debt is going to be $247,000. Wow. If you had started at your 20s, this is the big number here, is 270 versus the fact that you're still gonna have $247,000 worth of debt at the age of 50. Now, something I didn't even look into explaining into this video, because I wanna make a point about starting early, is the fact that this is just on one property. If you end up purchasing this in your 20s and you waited 5 years, you then build up that equity and purchased another property, and you're able to build your portfolio, can you imagine what that looks like at the age of 50? Now, I've got a video on this channel about how many properties you actually need to get to 100K of passive income. That is debt-free, okay? So if you want to get to $100,000 worth of debt-free passive income, you're not having to wait for the government to give you some sort of pension, you need to go check out that video. But essentially, you can see how every year is costing you money by you just putting off something and saying, I'm not ready for this now. Or the fact that you want that holiday a little bit more than actually going out and purchasing an asset. This is where we need to have a shift in our mindset. I'm obviously talking about this in my private Facebook group. It's completely free. I'm building a community around it. So that's why I'm pushing it in these videos, that it means that if your people around you aren't actually talking about this stuff, we'll come into the community and we can support each other so that we can have better lives for ourselves and our family moving forward. Guys, I wanted to keep this short. I wanted to keep this simple, but I want to make a very important point here, is that just by waiting a few years, you could be priced out of specific markets. And of course, there's new opportunities always arising. But as you can see, as you have that regret of, I wish I purchased 10 years ago, I wish I purchased 5 years ago in a growing market, the same thing is going to happen now. And it's going to continue happening. Unfortunately, time being our biggest asset is also for so many being wasted. Guys, it's about taking action. Take action today and start upgrading your financial literacy. I thank you so much for watching all the way through. If you haven't already, smash that subscribe button, and of course, share this video with someone that needs to hear this sort of stuff, okay? So guys, I'll catch you in the next video. Thanks, guys.